Stare at an unfiltered market feed, and the sheer volume of data is paralyzing. Hundreds of tickers, fractions of a cent updating by the millisecond, flashing red and green in a constant stream. Many retail traders try to conquer this noise by zooming in. They stare at 1-minute or 5-minute charts in complete isolation. This is a fatal error. Analyzing a micro time frame in a vacuum ignores the massive global currents that are actually moving the price. Without a structured way to process information, you are left gambling on short-term momentum. You're reacting to whatever candle is moving the fastest, rather than following a rigid objective system. Raw market data is designed to provoke an emotional reaction. Without a top-down filtering mechanism to organize that chaos, the market becomes a highly efficient trap for uninformed capital. The 2022 algorithmic model offers a specific defense against that noise. It operates as a strict top-down execution architecture, designed to force complete synchronization across multiple timeframes. Finding a hyper-precise entry on a 1-minute chart is entirely dependent on macro-level analysis that happens before the trading session even begins. This diagram illustrates the model's sequential 5-step analytical funnel. It starts at the absolute top with the global macro bias, filtering down through gravitational levels, structural ranges, and specific price action triggers, until it reaches the exact minute of execution in the time macros. Every single trade must pass through these binary conditions. If one step fails, the trade is discarded. This entirely removes the urge to guess, replacing it with an uncompromising operational matrix. We start at the absolute top of the funnel, determining the global macro bias. To do this, we measure the overall strength of the US dollar using the DXY index. This matrix shows the inverse relationship driving a risk-off environment. A bullish rally in the dollar acts as a heavy gravitational pull. It explicitly forces temporary weakness across correlated risk assets, meaning foreign currencies and stock indices are pushed downward. Once we know the overarching direction, we diagnose the weekly market condition. We have to strictly categorize the current week as either actively trending or stuck in consolidation. We map the new week opening gap, or NWOG, the void between Friday's close and Sunday's open. In a consolidating environment, this gap acts as a massive price magnet. The market repeatedly gravitates back, treating this exact zone as hard intraday support and resistance. Before analyzing a trade setup, we've established the dollar's trend and mapped the weekly price gravity. The system has already filtered out the vast majority of market noise. Now we push further down the funnel to the intraday structural range. We are looking for a prior swing leg, a distinct high to low move that occurs immediately before a sharp downward displacement in price. This chart shows the baseline geometry required for any trade. We take the structural range and split it exactly in half, establishing a 50% equilibrium line. The area above 50% is the premium zone. This right area is the absolute only region mathematically optimal for initiating a short position. Below the equilibrium is the blue discount zone. Down here, high probability shorts are completely exhausted. Initiating new short positions in this blue area is strictly forbidden. Look closely at this cross-section. The precise entry requires a specific price action signature, like a fair value gap, that aligns perfectly with that 50% threshold. You rely on strict mathematical geometry, waiting patiently for the market to retrace upward and meet your structural requirements. However, flawless structural geometry is entirely useless if it forms at the wrong time of day. This chart highlights the tightest filter in the entire architecture. This shaded vertical column represents the lunch macro, a strict 20-minute window between 10:50 and 11:10 a.m. A distinct algorithmic move is guaranteed to form within this exact time window every day. This time macro operates mechanically. It is an automated run designed to hunt and tag pools of resting liquidity, stop losses, and pending orders that have been left exposed in the market. Time is the ultimate validation layer. True algorithmic execution requires waiting until your structural patterns overlap precisely with these scheduled automated volatility windows. Pinpointing the perfect entry only solves half the equation. Preserving your capital requires immediate, rigid trade management. The moment your trade is active and price drops past that 50% equilibrium line into the discount zone, your entire operational objective shifts from execution to survival. You follow two non-negotiable rules. First, pyramiding, adding more volume to your position, must stop entirely. Second, you must aggressively take partial profits off the table. This mathematical enforcement of profit-taking ensures the system prioritizes long-term survival over trying to maximize a single position once the highest probability move is over. This chart reveals the fully synchronized architecture. We've tracked the global macro bias into a defined structural range, identified the fair value gap entry, and executed perfectly inside the 10:50 a.m. time macro. A valid setup exists only when these layers fire in perfect unison. Contrast this with the amateur approach. Most participants stare at a blank chart, guessing at random candlestick shapes without checking the broader trend. By adopting this top-down architecture, you stop reacting blindly to market noise. You graduate into an objective tactician, executing a defined multi-timeframe system.